New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, the Tax Lady, and this is our hour to talk taxes. And so we just want to invite you to listen in. We try to make our tax shows summer friendly for those of you that say, oh my gosh, what can they be talking about with taxes this time of year? Well, actually, you'd be surprised. Now, normally we have live phone-in calls, but every once in a while we just pull up all of our emails and we will talk about our emails. And so today that's what we're going to do. And I'm joined in studio with Chris Fabian.
Hello, Esther.
Hello, Christopher, and Tiffany Fabian.
Hey there, EG. How's it going?
So you two are related.
Yes, that's my best friend.
Okay.
Partner in crime.
So we're going to talk about the emails and what's cool about this. And I really enjoy it, really, to do this kind of a show because we get to explain why the law is, because we have, instead of having a bank of calls, we can kind of chew up stuff, and a lot of people are interested in these. So if you are somebody that wants to have your email read at one of our segments that we do, our email segments, send it to EG Tax, and we'll be very happy to help you and answer your email on one of these shows. But I always answer it right away too, when I get it. And by the way, if you're somebody that has gotten a letter, hasn't filed a tax return, haven't gotten a refund, EG Tax is open 9 to 5 Monday through Friday this time of year, and we will help you if you call us.
We can still e-file your returns right
That's
now.
Right.
This
We're
time
doing
of year.
tax returns.
Yep, still
if
electronically.
A big balance due. We can do offers and compromise. I mean, we didn't just roll up the carpet during at the end of tax season. We're there to help you. So if you get before you pay any letter, make sure that you have us take a look at it. Right, Chris?
Right,
Sure.
right, definitely.
All right, well, let's go to our first email.
I got Brenda, and she says, EG Tax, please give me some ideas to cut my taxes. I'm 49 years young, make around $75,000, married with a grown child, looking to make some changes. Better late than never.
Well, I guess the first thing that hits me is she's probably somebody that's working, right?
Right.
So the first thing I would like to say to Brenda is, are you in your pension plan?
Correct.
Right?
Correct.
Yep.
Now, why would that be important?
Well, a couple of reasons. First of all, if they match money and you're not putting it in, you're losing free money.
All right, so let's explain what that means, match money. So that means that the employer is giving you matches?
Yes.
No, you
For your
can.
cigarettes.
You'd want to find out from your human resources what percentage of your salary they would identify and match up into their 401k.
Right.
So, for instance, if you are at an employer and you make $50,000 a year and they match 3%, you'd want to take $50,000 of your salary times 3%,
Which is $1,500.
which is $1,500, and so they would contribute $1,500 as long as you are.
Contributed $1,500.
That's right. That's right. So there used to be a time.
So if you're not in the pension plan, what happens to that 3% match that the employer would have done?
it
you
goes
lose
to the
it.
wayside. You do not get
Right?
it.
Yep.
That's right.
So if you're listening, and whether you're Brenda or not, if you have a pension plan at work that offers an employer match, you need to be in your plan if you want to get the freebies from your employer.
Right.
And, we've worked it out that the truth is if you just put money in, like this lady, if she were to put in $1,500, like in your example, Tiff, even if she put it in and the company put in the $1,500 and she took it out the next year, she would have to pay a $150 penalty and probably $150 in taxes,
Right.
which is $300. But $300 after she pays the taxes, she still comes out $1,200 ahead because of the match, right? So
That's
even if
smart.
you put
Yeah.
it in and you got penalized, so that's the first thing I say to Brenda. The second thing is, does she own a home? I don't know
Correct.
if she doesn't give us that information. Does she own a home? A home is a great asset. The interest rates are dirt cheap right now.
Right.
It's got to be cheaper than renting, probably, because you're building up asset value, and you also get the itemized deduction for property taxes and mortgage interest.
That's right. That's
right.
right.
And so that's one of those really important decisions that you should make in life.
Another thing, if they own a house, they might want to consider getting a rental, a piece of rental property. Is, like you said, the interest rates are really low to buy a house, and so to have a rental, there's a potential for some investment that you can take advantage of on your tax return, because you get to do a Schedule E and money in and money out, and you keep track of all your expenses. And in the long haul, I usually see rental landlords do. It's a good tax shelter.
Right. True.
Well, she says she has a grown child too. She's married.
No, you don't know she's married.
Yeah, it does. 75 married with a grown child.
Okay, you're right.
Well, is the child still in college? Because you still may be able to claim the college credit. If the child is graduated from college and he has student loans out, if you do own a home and you have equity in it, it may be better off to take a home equity loan out to pay off the student loans at a much lower interest rate, and therefore then 100% of the interest would be deductible.
Right, which reminds me then, as I was listening to you, the tax aspect is like icing on the cake. It's the overall financial picture that really is important, Brenda. So, yes, I mean, like with the pension, you would save tax dollars. With buying a home, you would save tax dollars. With rental property, you'd save tax dollars. Like Chris was saying, if your child's still in college, you would save tax dollars. But here's when he's talking about paying off the student loan. In that situation, you wouldn't necessarily save tax dollars, you would save real dollars, right? Because it's a better financial move. Instead of having a 7 or 8% student loan, you now have a deductible, if it's a home equity, deductible 2 or 3% loan, and it isn't limited to $2,500 too.
Right.
So I think we beat that puppy to death, would you say?
Yeah.
Yes.
But I think the other thing, Brenda, if you are listening, call us at 632-7886 because we are very happy to sit down and talk to you, and we don't charge you.
Yeah, and another thing, Brenda, always keep it in the back burner as an option, married filing separate too. I know everybody's poo-poos it, but really, when you make a lot of money, you got two high income earners. If your income is about the same, and there's some write-offs that you can take advantage of if you do married filing separate, so that's always an option too.
True.
Rule.
Okay, what else we got?
I got Paul. He says, EG Tax, I'm planning on rolling over my traditional IRA into a Roth. I have $100,000 in it. My wife and I are retired and live on Social Security and a small pension. How much will that cost? Chris, what do you think? I think that's he shouldn't do it. Sounds like because now if it was a different story and he said he had a large pension, then maybe. But what do you think?
Right, because it's going to make 85% of his Social Security taxable. It sounds like he doesn't pay tax now. So you're looking at $100,000 is probably going to cost you easily $20,000 on the federal if you were to do that right now.
And on New York State, too,
and then
because
you'd pay
the
tax
first
too.
$20,000 is going to be tax-free, but the $80,000 will be taxable. But here's the thing, Paul. So if you want to get the money into the IRA, on the first $23,000 taxable income, you and your wife are not going to pay taxes anyway. All right? Right. So assuming that you have non-taxable Social Security because half of your Social Security is not over $32,000. There's no excess Social Security, and your pension is small. You probably can take out, I bet you, $15,000 or $16,000 a year out of your traditional IRA completely tax-free. So if you decide to get this money and put it into the Roth, you could actually roll over $15,000 a year for 5 or 6 years. It would get there without paying any taxes, and it's a win-win situation.
That's very clever.
Right?
Very clever. Yep.
And that's what people don't know, is that like the first, when you're married filing a joint return over 65, like the first $23,000 of income you have isn't taxable anyway.
Yeah.
So in his situation with Paul, he probably only has $3,000 or $4,000 in taxable income. So he's got $21,000 there that he can take out and pay nothing to very little in taxes. So even though you aren't required to do an RMD, you would want to make sure you take money out of your IRA.
There was a listener who came into our office like a few weeks ago, and he said you taught him that on the radio. And he said, my goodness, I could have been doing this for the last 7 years, and I think Esther ought to say it more often. Because,
Well, I just said it.
Yeah.
Okay, I'm Esther Gullius, the tax lady from EG Tax. We're going to take a short break, and we'll be back on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. This week we have a special show. We're answering emails, so don't call in this week. Save your phone calls for next week. And if you have questions during the week, you can call us at 632-7886. We'll be very happy to talk to you directly, or you can go to our website at egtax.com, and I answer your questions right away. So if you have a question and we aren't taking calls today, you can still email us. We'll text you back. And I'm joined in studio with Tiffany Fabian and Christopher Fabian, and we're answering your emails. So we just got done with Paul's email. What do we got here next?
Larry. Is this Larry from
Larry
Georgia?
from Georgia?
I don't know.
Larry from Georgia.
Esther, with all the flooding going on down south, I've been thinking, what is the rules for writing off damages from storms like that to your house? And so that's his question.
Okay, so that would be a casualty loss is what he's talking about, right?
And it's tucked away under Schedule A. And so casualty losses have to super exceed 10% of your adjusted gross income plus $100. So, for instance, if you make $100,000, it has to be over 10%, which is $10,000 plus that 100. So it's a really high bar you have to reach.
Well, actually, there's all kinds of caveats on the casualty loss. Like it can't be due to wear and tear.
Correct.
It can't be over a period of time. It has to be sudden, right? Unexpected and kind of an act of God, right? So that's what casualty loss is. But let's say that you like a storm comes in, right?
Yep.
And now your first floor fills up with water. That is pretty much an act of God, right?
Yep.
And unless the seawall in front of your house wasn't maintained and it broke and it was not due to a storm, it was due to your wear and tear, right?
And then don't forget whatever insurance gives you have to back away.
That's exactly right. So if you have a
important.
limited insurance policy, let's say the damage is $100,000 and your insurance company says we'll give you 40. Now you're out 60. Right? And your let's say your income is the 100,000. So now you have to take off 10,100 from 60, so it's 49,009 would be the casualty loss.
That's right.
And you better take pictures and have appraisers and have people come in to verify that this was actually your loss, because you have to substantiate your loss. But one good thing with the insurance company, they would come in and usually do a report.
Right. And, big thing is you have to go to your insurance company. You just can't say, I'm going to take it on my tax return. But also, if some of these storms, some of these areas are considered a national disaster area.
That even puts something else in.
That even turns it even more, because they'll waive the $100 fee, and, well, not fee, but the other extra $100 deductible. And they'll also let you amend the current year's return instead of waiting for the next year's return, so you can get your money that much sooner.
Pretty cool.
Or the last year's return.
Or last year. Well, that's what I meant by current.
Okay.
Yeah.
Oh, that's what you meant.
Yes.
Okay. I'm just clarifying. Thanks, Chris. So that's part of what a casualty loss is. It's a horrible way to get a deduction. And then if your casualty was $49,900, that's then multiplied by your tax bracket, right?
Yep.
Correct.
So if it took place, like let's say it took place in 2016 at the beginning of the year, and let's say your entire town was devastated, so that you lost your job and you had no income, that's when you'd want to be able to amend last year's return and put it on last year's return if it's considered a federally declared disaster area, because you'll be able to get that better benefit because you have a higher tax bracket, because obviously a casualty loss when you have no income doesn't do you much good.
That's right.
No, not at all. Not at all.
Okay. What else we got here?
Go ahead, Chris.
No, go ahead.
No, I thought you were putting on your glasses, so that's why I was like, I'm going to let you go. But then, okay, so we'll go. Becky writes, EG
Don't
Tax.
fight. Don't fight. I know you guys are married, but don't fight.
What is the difference between an accountable plan and a non-accountable plan for reimbursements at work? My job wants to switch to a non-accountable plan. What is a good thing, a better thing?
So, a lot of different, well, is it a good thing?
What's the meaning of life?
Yes, yes. Probably not a really good thing for you, Becky, because a non-accountable plan means they're going to say, I'm going to give you $500 a month. We don't care what you spend it on. We're giving you $500 a month.
And we don't want you to make an accounting of it.
Right. You don't have to give
Non-accountable.
us. You don't have to give us any receipts.
We're just
Turn
giving
in
you the
mileage
money.
log. We're just giving you money. Okay. Boy, that sounds pretty good.
Yep.
But it grosses up your W-2. So you're paying Social Security tax on that, income tax on it. So, but then you get to write everything off
Right.
on your tax return
If you can itemize.
if you can itemize. Well, are you going to save dollar for dollar?
No.
Not really, because you're only going to save what percentage that you're in the tax bracket. So if you're in the 25% bracket and you spend $10,000 on expenses, you're only going to get back $2,500 of what you spend. So you lost $7,500. So that's a non-accountable plan. Where an accountable plan, you go to your boss, and I'll go to Esther. Esther, here's my mileage log for May, and it's 553 miles. And here's some receipts. So my expense report is $750. Esther would turn around, write me a check for $750. So I'm getting dollar for dollar in my pocket.
And you get the whole $750 back.
And it's tax free.
I think the worst part about a non-accountable plan is when their W-2 is bulked up and they don't even know.
Don't know it.
And
Right.
so they're not taking advantage of
Okay,
it.
so I got a little example here. Let's say you got this girl here who gets $500 a month, so she's going to get $6,000 for the year. All right, and it's in her W-2, so she's paying FICA on that. So
Yep.
she's paying an extra $420 in FICA. So she goes over and she does her 2106, and let's say that she had a mileage around 20,000 miles. So she has about $10,000 in mileage and maybe $2,000 in other expenses. So that's $12,000. So she's thinking, wow, that's pretty cool, $12,000. But remember, the $6,000 is already in her W-2, and she's also going to pay taxes at 10% on that. So she's paying taxes of an additional $1,020 because of the $6,000. So then she goes over to itemize. So her 2106 says $12,000, right? Well, she was going to get a standard deduction anyway, right?
Yep.
And if she didn't have a home, she's only going to get a benefit of about $6,000 times her 10% bracket. So she's really saving $600 in taxes on the 2106, and it cost her $1,020 on her W-2. So effectively, being on the non-accountable plan cost her $620.
Wow.
Over what she would have done if she would have been on an accountable plan.
Wow.
Right? And she would have got a dollar for dollar deduction.
When you break it down like that, it really makes
It does.
So
and that's why sometimes in taxes it sounds so good. It's like the Roth. It sounds so good, but not everybody's going to do good by using a Roth, right?
I mean, she may be better off, and other people out there listening may be able to go to their boss and say, look, I want to go back on an accountable plan. Reduce my salary
That's exactly right.
by $5,000. So this way you will win.
Right. And many of those people with big 2106s end up paying AMT.
AMT. Yep.
And I had one guy who was paying this humongous AMT, and I said, look, you're better off going to your boss and saying, please give me a $20,000 pay cut, because this is costing me, I'm paying 26% on my itemized deductions. He was getting super whacked.
wow.
You know, and that's the thing. That's why tax planning is so important. You gotta, especially with some of these nuances in the law, you want to make sure that you talk to a professional, because what you don't know will absolutely hurt you.
Yeah.
Okay, that was good.
That was really
Good question. All right, what else we got?
Kathy writes in from North Tonawanda. I've been waiting since February for my New York refund. Now they want proof of my employer. What can I do?
Well, Boy,
Well, Kathy, you better give them proof of the
or else
employer.
you'll be waiting for your refund a little bit
really
longer.
is a shame. I know one of the news agencies came out the other day and did a story about it, but New York State is saying that they're asking for proof of the employer that you work for because of fraud,
Yep.
right? That's, it's hard for me to believe that.
It's pretty funny when we have people who work for New York State. They get their check from New York State, their W-2s from New York State, and they have to send it themselves back to New York State.
to prove it's really them.
Yeah. So the fraud doesn't really.
But anyway,
Resonates.
so to ignore it would be a horrible thing. They'll never issue you your refund unless you comply. So if you're somebody that's gotten one of those love letters and you're saying, I'm not going to do it, it's up to them, well, then you're never going to get your refund. I'm going to tell you right now.
I was going to say
Have
today.
we called a congressman yet?
Oh, congressmen have been writing letters and they get garbage responses back too.
I've been saying also today was the third person that I said that they took what they owed New York State for 2015 and New York State applied it to the wrong year. So they're getting a bill with interest and penalty, and one client was going to pay it. So you really want to make that phone call, because a lot of times they've been applying your 15 payment to a different year, which is just baffling to me.
And again, if you don't know what to say to them, and to just say, oh, it's only $400, I'll let them keep it. That's all. If all these taxpayers in New York State gave all of them $400 that they weren't entitled to, that would be highway robbery. It is highway robbery.
I'll
anyway.
take, if you don't want it, give it to me. I'll
Well,
take
anyway,
the
but
$400.
EG Tax will help you.
Right. The best thing to do with these letters, because it says you can write it in, you can fax in your response or create an online account. The fastest way, and fastest means 90 days, to get it resolved is by creating an online account and uploading the information to New York State. Because if you fax it or send it in, it takes 30 days for them to acknowledge your information first, and then the 90-day calendar begins.
Okay. Well, I'm Esther Gullius, the tax lady from EG Tax. We're going to take a short break for the news. We'll see you on the other side. Thanks for listening. Hi, I'm Esther Gullius, the tax lady from EG Tax. This is Ask the Tax Lady. And this week it's a little different show because we are not taking live phone-ins. We're answering emails that you send us in. And it gives us an opportunity to really kind of collaborate. And you'll hear us collaborate because taxes are very difficult, and there's many aspects to one subject. So I think you'll find it interesting. We will be taking your live phone-ins calls next week. And should you have a question during the show and you just wanted to email us while we're at the show, you can go to egtax.com, and there's a place where you can ask a tax question. We'll make sure we'll get to you right away. And obviously, if you email us, it could be your email that's on one of the next shows. Okay, Chris, Tiff.
I got Pete. Peter writes, EG Tax. My girlfriend and her 2 children moved in with me. She does not work, and I pay for everything. Can I claim them on my taxes? Well, it sounds like as long as they live with you for the entire year and you provide more than 50% of their support, that you could claim them on your tax return. And so the answer is yes, he wouldn't get to claim them for earned income credit purposes
Or head of the household.
But you could claim the children and the girlfriend on your tax return as long as they were with you for the entire year. You paid for the support.
How about the qualify?
That's what I was thinking.
Child tax credit.
He gets the child tax credit. Yes, he gets the child tax credit. And I was also thinking, you want to be careful with the kids, because if somebody is paying child support for the kids and there's a right of refusal law, and so I'm thinking that maybe there's an issue with the father of the kids if the mother doesn't work. Do you agree with me, Chris? Or
We gotta ask a lot of questions. It's not a simple yes or no.
Well, I mean, it all depends. Now, if the children are the children are being maintained by this person, and he's furnishing over all of their support, right? and the divorce decree doesn't stipulate
Who
that
gets to claim.
and there's no 8332 signed, then this guy gets to claim it, right?
Right. And another simple solution to even get better results on your tax return and do better is say I do. Get married.
That's true.
That's
true.
And
Get married.
then he would get the earned income credit. For,
No, necessarily. It all depends on their income level.
right. If
But
they,
it would
but
qualify.
they would then
if-
become qualifying children.
Right.
So they'd get they would get the personal exemption for each of the kids for sure,
Yep.
and then they'd file married separate. I mean
Right.
married joint.
Yes.
And
Yes.
actually, there isn't that much benefit.
Well,
if
it
you think about
depends. Well, it depends on his income. If he's only making 30,000,
Right.
it would make a big difference.
It would, but if he were making 50,000, he still gets to claim the kids. He's still claiming her.
Yeah.
So the filing status isn't going to be that much different. It really depends on what tax bracket they're in.
that's right. That's
Yeah.
right.
But the key thing is they have to live with you the whole year.
And in order for you to get them change the status from single to head of the household, they have to be your qualifying relatives, and these are not your qualifying relatives. Okay.
Right. That's right. Good question. That's a really good question. And then I got Teresa. EG tax. Teresa. What is the penalty for not having health insurance this year? I never go to the doctor, and I'm paying $450 a month through the exchange. Would it be worth it to drop the insurance? And so the truth is that there is a penalty if you don't have health insurance. However, there's a lot of exceptions to the penalty. And so if you don't have health insurance, you're opening yourself up to the potential
Does
penalty.
Teresa say how much her income is?
She does not say, but
Well,
she's getting it through the exchange, and she's not getting Medicaid. So that
She's paying $450 a month if it is a single plan. It must be up there, I'm thinking.
her
Like
income.
35,000.
At least,
right?
if not higher. So,
If she made 30, right, the penalty would be 2.5%, right?
or $695, whichever is higher.
Right. So that's $750. So this penalty would be $750.
$750,
Right.
and she's paying
so,
$450 a
so
month.
she really. So here's the Russian roulette. $750 is what the penalty would be, unless there's an
Potentially.
exception, right? Like it's a hardship or something, or. And obviously, if you don't get hit by a car and you don't develop a catastrophic disease, you'll make out.
Right.
But if not, now, but here's something that's interesting. Could Teresa start off not having health insurance, okay, and then she finds out that she's got a bad case of pneumonia? Can then she sign up for health insurance?
I would think so.
And then they would cover it anyway.
Yeah.
So,
Wow. You're just thinking out loud, aren't you?
yeah.
Well, she would have to have a life change in order to sign back up.
That's a
Big
Well,
change.
not according
Child,
to child,
getting
marriage,
married.
divorce, something like that, loss of a job, something
In
like
order to
that,
get
to
into
get
the-
back on
Into
the exchange. So, I mean, I like your thinking.
I mean, because really, if you wanted to gamble, and you kind of had a life situation, and you're tucked away in your back pocket, and you could get sick and then say, "Oh, today I'd like health insurance," and they would put
Yep.
you
She
on.
may-
Another thing she might want to look at her employers. I'm sorry, Chris, go on. You were saying her employer's coverage.
Right?
But maybe the employer doesn't have coverage. It sounds like.
I mean, she may want to look at what plan she has through the exchange. She may be on a gold plan or a platinum plan, and that's why she's paying a
That's
lot
right.
of money.
Maybe she wants to get
Go,
that cheapo
go
plan.
drop down to the bronze, where maybe now it's only $70 a month. So, but you
That's-
still
and
have
you
it,
wouldn't have the penalty.
right?
Right.
So,
So now here's the thing. I'm thinking out loud again. So let's say I'm on the cheapo plan, right? The $20 a month plan. I know you have to be lower income.
it got to be lower than 30,000.
Yeah, but all right. So let's say I'm on the cheapo plan. Let's say 150. It's costing me a month for coverage. So now I have coverage, but I find out that I have a very catastrophic disease. Can I bump myself up to the platinum plan, or do I have to have a life-changing event to do that?
I think you got to have a life.
So I just can't be
You
switching
can't
plans.
just switch plans.
Shoot.
And everybody
Okay.
would do that.
But what you can also do though is go on a payment plan with the hospital,
And then go on the
and then
platinum
file
plan.
Chapter 13. I didn't. Say,
Okay. But it is interesting with this whole healthcare thing because you find people that are playing the angles all the time.
Yes.
Yes. Oh, definitely.
Yes.
Definitely.
And it's evolving. It's just all new, and so people are learning. And like the Medicaid world is just a different, as Esther has said, a different animal. And so it's just evolved.
And Medicaid is not your old Medicaid.
Nope.
The old Medicaid, you had to be pretty much a destitute person.
Right.
Now, under new Medicaid, you can have assets, you can have a house, you can have money in the bank. Your income is lower. But if your income is lower, you'd qualify for Medicaid, provided you're not
Right.
65.
And if you're on the exchange and you get married during the year and your spouse works, notify the exchange right away that the income in the household changed.
Yeah.
Because how many people have we seen? A couple weeks ago, someone had to pay back $2,000
Bad.
back because they got married during the year. And they're like, but it would have been cheaper if I went on my wife's policy. Well, you should have went on your wife's. I mean, do you think they're getting away with something?
So here's the thing then. The important thing is all these life situations, I hate to say this, but before you get married, call us. Because
Before you have a child.
we really want to help you. Because after you get married, it's too late. Once that tax year closes, it's too late.
Any life change, not just for health insurance, but any
That's
life
true.
change.
You find out you're pregnant,
impacts.
you have to call
Auntie
your
Esther.
spouse and then call us. And then we'll tell you what it means.
Right.
Okay, let's go back.
I've got Tom. He says, EG tax. I have most of my income from investments. What can I do to cut my taxes? My home is paid for. Should I get a new mortgage or give my car to charity? Any suggestions, Tom? And so,
Again, Tom doesn't tell us how much his income is.
right,
But if he's in the 15% bracket or lower, what does that mean about his investments?
0%.
He pays
on
no
long
income
term.
tax on it. So
Right.
he wants to make sure his investments are qualified investments.
Right.
Does that mean that he has to call you first, or what?
He
does
would
that
have
mean?
to call us, call his broker,
Well, a qualified
at-
investment means that it would qualify for special tax treatment, right?
Right.
That's a U.S. corporation that you held it a certain amount of time, and if you're in the 15% bracket or less, it's a qualified capital gain where you'd pay 0% in income tax.
Right.
So it sounds like if this is your situation, you might already be in a very, 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 very low tax bracket. I met somebody yesterday who came in for tax planning, and they made $100,000 a year, and they paid $9,000 in taxes, and they said, "Gee, that seems like a lot," and I said, "That's 9%."
Not so.
I said, so effectively, you're in the 9% tax bracket. And they said, well, why does it feel like so much more? And I said, I don't know, but you are in the 9% effective. Your effective tax rate is 9%.
Yeah, and the thing was, he's saying about should he get a new mortgage, and usually the interest that you're going to pay over the lifetime of the mortgage is far greater than the tax savings that you're going
Well,
to
it
yield.
is. I mean, let's assume this guy is in the 15% bracket, okay? So he's not really paying very much in taxes at all. Maybe the only taxes he's paying is because of his Social Security being taxable or something.
Right.
If he got a mortgage, right, and let's say he was paying $10,000 in interest, if he's in the 10% bracket, what is he really going to save in taxes?
$1,000.
$1,000. So you're paying $10,000 to save $1,000.
Right.
Not a good
Not a
plan.
good plan.
Not a good plan at all.
Not a good plan. And sometimes it
And
took
do not give your car to charity,
Right.
Unless you want to give your car. I
Yeah.
mean, giving something to charity is something. It's an issue of the heart, and the benefit is that they're going to let you deduct it on your tax return. In this situation, if he's given his good car to charity, it doesn't sound like it's an issue of the heart. It sounds like an issue of the pocketbook.
Right.
And if the car's worth $10,000, again, he's only going to save $1,000 in taxes.
So sell the car if you want to give it away and get a new car. Make sure you sell it, but don't do that.
Right.
We had somebody call today at the office who was selling a boat, and so she was nervous because the boat was going to be $45,000. But the truth is, there was no gain on it. It
No
wasn't.
gain.
It wasn't an
Personal capital,
antique. It wasn't a
personal,
collectible.
tangible asset.
Right. So sell the car, and you might be better off.
So yeah, first of all, the thing I would say is come on in. Let's look at what your real tax rate is. Let's show you what you're really paying in taxes. Most people really don't know.
Yeah, that's what I
And-
was thinking. What
and,
that person did yesterday was beneficial.
You know, it was really great because when they left, they said, wow. Because I said, this is what you can do here, you can do this here, you can do that. But in order to save more money, you have to mess up your life. And they said, well, we're retired and we really like our life. And I said, then enjoy paying $9,000 in taxes.
That's
because
right.
that's the way it is.
Yeah.
All right, I'm Esther Gullius, the tax lady from EG Tax. We're answering your emails. Call us during the week if you have any questions, if you get love letters. In the meantime, if you have any questions, you can go to our website at egtax.com and ask us a question. We're going to take a short break. We'll see you on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. Today we're doing a little different show. We're just answering your emails, and if you want to have your email answered, you can go to our website at egtax.com and click on the thing, Ask a Tax Question, and one of these shows will be listening to your email question. But in the meantime, we're not going to take live phone-ins this week. Next week. And again, if you're getting love letters or anything or haven't gotten your refund, give EG Tax a call. We're open 9 to 5 Monday through Friday, and we want to help you. Mm-hmm. Okay, what else we got?
I got Steve. He says, Esther, I would like to take extra money during the summer. What do you think if I change my withholdings on my withholding form and then change it back in September? Do you think that's a good idea? And so I just want to chime in really quick and say that could be a good idea. I know that I had a client during tax season, and she changed her withholdings back, and I think Esther and Chris see where I'm going with this, for her daughter's wedding. And then she was sitting down with me, and we were doing a return, and I says, oh, my God, we'll call her Sally. Sally, you had no withholdings on all this money. And that's because she forgot to change it back again. So it can be a good idea.
Well, I mean, here's the thing. All these people that are waiting for the New York State refunds or federal refunds, it's because they sent their money into the federal government and they're pleading with them to send it back, right?
Yep.
I'm not a big proponent on getting a refund. I'll tell you, because it is stupid. You're sending in your money to these people and they're using it and you don't get to use it, and it's your darn money and they're giving you zero on it. So I think you should change your withholding, and I think you should be very close to even, or you can even owe them up to $1,000, and it's an interest-free loan.
And then also,
But you want to make sure, not like Sally, Tiffany's client Sally, who didn't have anything withheld. I mean, you have to be a responsible adult. But I will tell you, with all the identity theft going on, with all the problems that the federal government and the state of New York is having with identity theft, and they're holding up the refunds, and they're asking you to send in a urine sample. I'm only kidding, but just about before they send you back your refund. You are smarter to change your W-4 to have less withheld, so your refund is smaller, so you get your refund every week when you get paid.
That's right. And then not to mention, if there's, like Chris mentioned, a life change, you might want to look at changing your withholdings. So if you get married, if you have a child, if you go back to school, if your child goes to college.
You should invite us to all life events.
For many
the
reasons.
christening of the baby,
There's a
the birth of the
multitude.
baby, the marriage,
The
the
divorce,
I
the
mean, we
death.
ought to be there and have a little huddle with you.
Yeah.
Because it really, all these life events really do change your life. I wish I could look at everybody's tax return. Yesterday I did a tax return for a gentleman who used a tax
Something.
program. And so he said, and my girlfriend says I should come see you. So I looked at his return and I said, gee whiz, you know, your 1098 this year says your property taxes are $6,000. But last year you only took $1,500. And he said, well, that's because I only took the property taxes. I didn't take the school taxes. And I said, no, wrong. You have to take school and county and city are all deductible as, and so we amended and got him back like $700 back, you know.
Boy, it would
I wish I could look at everybody's tax
only
return.
cost minuscule to get his tax return done, and so he shot himself in the foot. So, but I
Right.
bet
Well-
you he won't do that again.
He won't. He's going to
Yes.
come see Auntie Esther
That's
again.
good. That's
But
good.
I mean, you know, we talked about he works out of his home.
Right.
He didn't know he could take an office and home. He's an outside salesperson, you know. And so those are all those wonderful things where you can really help somebody to minimize their tax bite. right?
That's right.
And maximize their refunds.
That's right.
Did we answer that question? I have
think
no
so.
idea.
We did.
I got lost in the answer.
I think that Steve should change his withholdings and then change it back again.
I
Or
don't
just
think,
should lower it
What he
permanent
should do is
to-
lower it and then give us a call and let's see what his withholding
numbers.
are so we can project what his liability is going to be so that he can keep it low.
Right.
A lot of my clients that have tried this, they say, I really do like the big refund, but it's great to be able to pay my bills all the time. And they keep it so that there's less going in.
Yep.
Okay, Ben writes, EG Tax, why can't I claim my loss on my IRA? It has dropped around $40,000 in the last couple of years. Any suggestions on how to make up the money I lost?
Well, he's obviously in a traditional IRA.
Yes.
Okay.
I would.
Roth is a different story.
Right. If it was in a Roth, that would be
They
different.
could close it out and claim.
Yeah.
And claim it. Right. If it was a Roth IRA and he had put $200,000, for instance, into a Roth IRA, it was after-tax dollars.
Same with an annuity. You can also
Or an annuity. And so because it was after-tax dollars, if he closes it out and he only gets $160,000, he's lost $40,000 and he could take a $40,000 loss, right?
Right.
Miscellaneous itemized deduction subject to
Again,
2%.
for a Roth IRA for people who
Right.
just turned it
But
on.
a traditional IRA is deductible when you put it in. So if he had put $200,000 into a traditional IRA, he wrote off $200,000 in income against that IRA. So when it goes down in value, the IRS doesn't allow you to take the loss because you've already taken the deduction.
Right. And isn't it amazing how people, like Ben, who wants to take the loss, but they never say anything when it goes from $200,000 to $300,000. They don't say, "Do I have to pay tax on that $100,000 now?"
Yeah.
But the loss they do.
Yeah.
But it almost sounds like he's in a high risk plan.
Right.
He's
That's
his
what I was- 'cause
allocations of his investments.
He's asking what he can do, and now, my God, the rule of thumb is now he's got to ride it out. He wouldn't want to switch to a low risk. I mean, he's lost $40,000.
Well, I don't know about that. I mean, if somebody punches me in the face, I'm not going to stay there and say, I got punched in the face
but
once.
they always say,
That's what they
I mean,
always
we're
say.
not financial people. I would say call the boys that are on the radio
Yes,
before
Mike
us.
and Glenn.
Give them a call. Sit down with. If you have a financial person, sit down with your financial person and say, "What am I doing wrong?
Yeah,
what are
I
we
guess
doing wrong?"
Usually it helps when you yell at them. At your financial person and say, how come? Because if they put you in a high risk and you didn't know it, you need either a new financial person or you need to have a very, very important come to Jesus meeting with them, right?
Yes.
Okay, what else we got?
Lou writes in, I am thinking of selling my rental property. I had it for 30 years.
Whoa.
I am moving to Florida. Should I wait to sell it until I'm a Florida resident to avoid paying New York tax? I can sell this property for about $125,000 now.
well,
Okay.
it's fully depreciated.
You tell good old Lou how sad he should be. Well, actually, we have good news and bad news, right?
Right. If you just sell it, you're going to pay tax on that $125,000, federal
Because
and
he has pretty much a zero basis.
yep, yeah, depending if you put a new roof on or
I
anything.
mean,
but,
for all intents and
that's
purposes, it's probably zero basis.
right, but you're still going to pay New York state tax because the home is in New
York
York.
State.
The income was made when you were in New York. So, good idea thinking you're going to avoid paying New York, but unfortunately, you still got to pay New York tax. But what thing you might?
But here we come on the white horse. Dun, 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 dun. All right, but what can he do?
Well, he can do what's called an exchange.
Righto.
And that's somebody we've had on the show in the past, Russ Gullo, who does this. Where now this gentleman's moving from New York to Florida. He can exchange his house up here in New York, the rental property, for a rental property down in Florida and pay no tax on that exchange.
All right, now here's the thing. I think people think this is a lot harder to do than it is. The truth is, he's just going to put his house up for sale here in Cheektowaga or wherever, and somebody's going to say, I want to buy it. Then he's got time to identify a house that he wants to, another investment property, rent real estate down in Florida. So he identifies that. What happens is the closing takes place here just per normal, but that's where Russ gets involved. He actually takes title to the property until the new property gets ready to be bought in Florida, and then he takes title to that and exchanges it and does all the paperwork.
He's your negotiator.
Right.
It's like your Priceline negotiator.
Right. And so what happens is Russ does everything behind the scenes. You do nothing up front. And how much does he pay when he sells it?
This one up here, nothing.
Right, because the old basis goes to the new basis.
Yep,
Pretty cool.
Yep. So if the new rental house in Florida is $200,000, for tax purposes, the house is only $75,000. He gets to write off, and then when he sells that house in Florida, he'll eventually pay tax.
And I was just kind of doing the math. He would save about $50,000 in taxes.
Wow.
That's a lot of bread.
And what's cool, and I have to tell you, my brother has rental property in Detroit, and he's just moving to Florida. It's really interesting. And I just said to him today, why don't you exchange all those properties? And he says, because my properties in Detroit have very little value, and the properties in Florida have high value. And I said, well, wouldn't you rather have 3 good properties than 20 bad ones, you know? So I think that's what he's going to do. And what's great is then he can avoid the taxes. And it is an avoidance because you still do ultimately pay taxes.
It's a deferral.
Right. Unless you die and you're lucky and get dead first. That's my strategy. Defer, die. Then my kids have to worry about it. Well, anyway, I'm Esther Golias, the tax lady from EG Tax. If you're somebody that's gotten letters, you haven't filed, you have a balance due, they're writing you letters, the state of New York isn't paying your refund, the federal government hasn't given your money back, you don't understand about Obamacare and you need help with that, because, by the way, we do that at no charge. You want financial planning, you're planning for retirement, you're going to get married, you have new babies, anything, EG Tax is there to help you. And when we talk to you over the phone, there's no charge. And when you come in for a consultation, there's no charge. And we really want to help you. And so until next week, I'm Esther Golias with Tiffany Fabian and Chris Fabian. If you need us during the week, call us at 632-7886 or go to our website at egtax.com. We thank you for listening and have a great week.